I'm in agreement that the low could be in. I mean, it's all probability based, but we're following the exact trend. There's usually a little bit more check back to that previous low or close to it. The big question to me really comes down to what the stock market's going to do. The NASDAQ just revisits your October lows, which is around 10,000. That would be about a 30% drop in the NASDAQ from here.
Wow.
I think we see the 15,700, 15,500 lows again on Bitcoin.
Bitcoin's performance in the first half of the year was noteworthy, transitioning from under $20,000 in December to exceeding $30,000 per coin in April and surpassing $31,400 in mid-July. This led investors to anticipate a robust second half. Despite subsequent price decreases, there is a prevailing hope that the primary cryptocurrency and the broader crypto market will outperform, reclaiming key support levels that have become resistance. This potential outcome is supported by a prominent technical analyst who points out Bitcoin's advantages, particularly when contrasted with other cryptocurrencies that are grappling with regulatory scrutiny in the United States. Moreover, the anticipated approval of a Bitcoin ETF and the upcoming halving event are expected to trigger the initiation of a new crypto bull market. The analyst previously projected that the endorsement of a spot ETF would generate a rapid 10% surge in Bitcoin's value upon announcement, accompanied by substantial investments from institutional players once it secures official SEC approval. Despite these positives, the analyst maintains a bearish stance on Bitcoin and altcoins. During a recent interview, he expounded on the persisting macro-level uncertainty that could impact both the stock market and cryptocurrencies. He predicts a considerable stock market decline and further cryptocurrency downturns before the year concludes. This prediction stems from his belief that the U.S. economy might enter a recession, a forecast he has advocated for months. He points out that the markets could be severely affected by the Federal Reserve's aggressive tightening measures, leading to a scenario where Bitcoin's value could plummet to as low as $9,000 per coin. This would constitute a 65% drop from its present value and an 86% decrease from its previous all-time high.
Big question to me really comes down to what the stock market's going to do, right? Because I look at what Bitcoin is now. Bitcoin is becoming more and more widely accepted. Institutions are getting more and more interested. We see that from the spot ETF filings that we've seen. So there's a lot of positives. The only negative for Bitcoin, because Bitcoin's not caught up in the securities regulation stuff. We know that from the SEC. So the only negative is if it's a risk-off scenario where we see a big risk-off in the stock market that, let's say the NASDAQ dropped 20, 30%, then it probably bleeds into crypto and causes Bitcoin to drop back to those lows or go lower. Again, I think my worst case scenario would be that 9 to 10K level. I look at Max Payne where people would just totally throw up their hands in the air and say, I quit. It's probably if we broke that level. But I only think that happens if we get that big stock market collapse. So other than that, I think you start to, look at key levels. Like I have a $25,000 level, which was where the BlackRock news came out about the spot ETF. We were at 25, and then we got that move to 31. And then if we break 25, you have to look at 20. 20 was where Silicon Valley Bank failed, and we saw the big pop in crypto because of that, or the big pop in Bitcoin because of that. So those are two key psychological levels, 25 and 20. And then again, what I'm going to do is I'm going to treat it each as a level, like that. It's support until it's broken. Once it's broken, then the next level support. If that gets broken, then the lows could be tested. But as a technician, that's how we have to treat it, right? We can't assume anything. The charts have to guide us to that. And the NASDAQ we've seen have a pretty substantial rally. It came within about 10% of its all-time highs. I think it's worth noting that even though Bitcoin doubled from its lows, it never came within 10 or 20 or even 30% of its previous all-time highs. So even though it was a great bounce on Bitcoin, relative to the NASDAQ, it actually underperformed in that way. Now, if the NASDAQ were to just go back to, in my opinion, if the NASDAQ just revisits your October lows, which is around 10,000, that would be about a 30% drop in the NASDAQ from here.
Wow.
I think we see the 15,700, 15,500 lows again on Bitcoin. If we break that and we start testing some of these lower trend lines down here, where we get sub 10,000, that's where you probably get down to that 10,000 marker on Bitcoin. So, I mean, in other words, to see that big of a drop in the NASDAQ, things really have to get screwed up in the economy and in the global economy. So there's maybe not a huge chance of that, but that would be your worst case scenario. Unfortunately, I do. I mean, again, you look at some of the data, the jobs data stayed strong, but the underlying jobs data in the U.S. is starting to weaken, where we're seeing more part-time work getting taken, which tells you, people don't go right out and say, hey, I want a part-time job. they go to part-time when they can't find full-time. So it's still counted as employment, like you're not unemployed if you have part-time. And so that's kind of misleading in the numbers, but we're seeing that rise. We're seeing, still housing and interest rates here compared to what we're used to are sky high here as well. That's putting a lot of pressure on things. And then you look at where the Fed funds have, the Fed has raised interest rates to such an enormous level in such a short period of time. And we have to recognize that you don't see that effect for 6 to 12 months. And so if you take 6 to 12 months out, we're still, the economy is acting as if the Fed funds rate is about 3% right now. So it still has another 2 to 2.25% to 2.5% to go to get that full effect of what the Fed has done. And so right now, I mean, to me, it's a situation where, yeah, I mean, there's going to be some sort of dump. The question is, do we get to those October lows and do we get below?
Across social media platform X, Soloway, a perceptive market analyst, succinctly outlines the recent stock market scenario. The recent dip in the market, coupled with the Nvidia rally's diminishing momentum, prompted Soloway to highlight the cyclicality of investor behavior. He notes that markets often peak amid widespread euphoria, followed by a domino effect of panic-driven selling as investors react to one another's actions. A significant shift in market dynamics has emerged since the engulfing reversal candle on July 27, 2023, observed in the S&P 500. The prevailing buy the dip strategy has given way to a new approach of sell the rip, with institutional players capitalizing on retail-driven buying opportunities. Soloway cites the Nvidia case as emblematic, where institutions utilized heightened volume to unload substantial positions, indicating a changing landscape. Soloway also delves into economic indicators, pointing out the contraction of the M2 money supply by 3.2% in July due to rising interest rates. He observes the challenges in achieving a soft landing or avoiding a landing altogether, while investors continue to buy the dip despite underlying data indicating a weakening labor market and concerning trends in consumer spending and debt.
I mean, you don't want to sell after a major collapse because inevitably you'll get some sort of bounce. Now, the question is, when you get that bounce, do you then use your logic and say, okay, I got the bounce that I was thinking I was going to get, and do I exit, or do you then get greedy and say, oh, well, if it bounced this much, maybe it can go this much and this much and this much? And that's the tricky thing, is that we're always dealing with those inner emotions, which can kind of make us do the wrong thing at the wrong time. So for me, I'm actually been nibbling on a few of the altcoins down here. So this is the Litecoin chart, right? And we know that they had their kind of halving over here. It had that big run into it. And then we've really, I mean, this is a tremendous drop from $115 down to about $60, about a 50% drop. And what I'm looking at is I'm looking at supports right here and maybe a retrace bounce back to 75. Now, I only start, and this is how I trade to kind of mitigate my own emotions, is I only have a tiny position on that. I think it's 3% of my portfolio. So if it goes down to this level, I'll pick up a little bit more. I'll dollar cost average. And if it goes here, I'll dollar cost average. At one of these levels, you'll get a big bounce. And then you have to be ready once you're in the money to say, okay, I got my bounce, wherever it may be, and I'll take it off the table. So at least on a trader's mentality, that's how you have to be. You have to be nimble. You always want to leave yourself the ability to maneuver. In fact, I think it's one of the most overlooked things in trading is people go in and they go in so heavy that they can't trade around their core position. And then you get yourself in a position where it goes lower and there's nothing you can do about it. You just start hoping and praying that you're going to get a bounce. But what I do is I go in small so that inevitably I'll be wrong a fair amount. I can maneuver in at lower levels. And when I do get that bounce at one of those points, it puts me back to break even or in the money. I take a little bit off. I let that core position continue to run. If it keeps running, I take a little bit off again. If it comes back in, I can buy back in again. And so it becomes much more of a dance with a trading setup. And I think that's super, super important to do versus going all in. Yeah, you might make $1 million if you hit the exact low, but I can tell you from experience that happens less often than the opposite. You know, letting go of the past just in life in general is one of the most important things. When we're ruled by the past, it's going to rule our future, and we're going to make the same mistakes over and over again. You got to let go of it and understand, and it's very freeing to do that, by the way. Sometimes when you cut a loss, initially seeing that negative P&L closed out sucks. But all of a sudden, it's like, okay, now I can go back to the basics. I can go back to what the charts are saying. I'm not, basically hogtied by what's happening in this one position. I'm not constantly looking at that negative P&L. And so the other thing I would say to people is, for me, when I still remember vividly taking a massive loss in my early career, I basically in one day blew up about 80% of my account, from 100 to 20K. And what I did was I walked out of the house. I took a walk, and it was a beautiful sunny day. And I was thinking about it, and I said, you know what? I'm young. I can still rebuild wealth. I have a roof over my head. I have food that I can eat, and I have, basically my health. And that's really what we need, right? Everything else is gravy. And if we work hard and we learn from our mistakes, then the money will come, right? I mean, I didn't really make a ton of money until I was in my late 20s and early 30s. That's really where the money started to come. I was struggling in most of my 20s to figure out trading, and I was losing consistently. But it was always reminding yourself, if you learn how to do this, you will make money very quickly, but you have to learn how to do it the right way.
In his recent update on trading platform X, Soloway addresses Friday's stock market movements, the possibility of another rate hike, and the overall health of the U.S. economy. The initial market sell-off in response to Jerome Powell's hawkish comments indicating a potential rate hike in November was quickly counteracted by buyers stepping in. This shift was attributed to a closer examination of Powell's remarks, highlighting the economy's continued strength and absence of recession signs. This resilience supports the no-landing perspective, crucial for justifying potential all-time market highs. Soloway further examines the job market's durability while also pointing out emerging vulnerabilities. He raises the question of when these vulnerabilities might escalate to a tipping point. He emphasizes that the complete impact of rate hikes takes time to materialize, with the current economy likely only experiencing the effects of a 3% Fed funds rate, despite the range being 5.25 to 5.5%. These factors underpin the bearish perspective. Soloway additionally underscores strain within the U.S. economy, noting indicators such as substantial U.S. debt interest, surging mortgage demand, $1 trillion in credit card debt, and an increase in auto loan defaults. He predicts an inevitable breaking point, with uncertainty around which catalyst could trigger it. The focus shifts to upcoming economic data, with Soloway highlighting the significance of forthcoming indicators. These include consumer confidence data, ADP non-farm private employment data, ETPC index, personal income and spending data, and non-farm payrolls. Soloway speculates that strong job reports could challenge the prevailing no-landing sentiment, potentially leading to market shocks. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.